Welcome to part 1 of lecture 11-A. Before we begin the lecture, let's do a quick review from the previous topic, and that had to do with property, plant, and equipment. So, what is the correct number of years over which goodwill must be amortized? Well, it's a bit of a trick question because it turns out that goodwill is not amortized at all. Just like land, goodwill is not amortized because theoretically it doesn't get used up. Now, it can get damaged in if there's a scandal or a product, bad decisions that impact the reputation of the business or something like that, in which case you would do a journal entry to reduce the value of goodwill. There would be a loss on goodwill, and that is called impairment. But pure and simple goodwill itself is not actually amortized. All right, so today we're going to talk about current liabilities, and we're going to get into a little bit of detail in payroll as well. So, current liabilities. The first one is accounts payable. Now, we're all familiar with this, right? And so, when a company buys something on credit, the liability is recorded as an account payable. Okay, we all know that. And the journal entry is, say debit supplies for, $100, and credit accounts payable, which is abbreviated AP. Now, but what if we pay tax on that? Well, turns out that GST or HST in those provinces that have it, it's not quite an expense in the way other taxes are. The way GST works is a business, it's a value-added tax. So a business only pays tax on the profit it gets on a buying and selling transaction, not on the full amount. So if we have GST at 5%, then on the supplies, let's say we're buying our supplies here again, $100. We collect GST, and that goes into an account called GST recoverable, and that's $5. And so the total amount accounts payable is $105. Now, this is called GST recoverable, right? That GST recoverable is a current asset, not an expense. Why? Because it's recoverable, meaning we will get it back, as you will see very soon. So, we previously, in I think Chapter 9, introduced the concept around a note payable. A note receivable in current assets. Note payable is just the opposite side of the business transaction. So what is a note receivable to one group is a note payable to the other party. Okay? And so instead of using interest revenue and interest receivable, we use interest expense and interest payable. Same sort of deal though, right? Assuming Brenda borrows $1,000 at 5% in maturing in 1 year, well, at the time of borrowing, she would record a debit to cash and a credit to note payable. And at the time of repayment, we have to get rid of the note payable, so we're going to debit the note payable. And we know we're paying cash, so we're going to credit cash. The note payable we know is $1,000. And then the difference in between is interest expense. And it was 5% on $1,000, so the interest is $50, and so the amount of cash going out the door is $1,050. And next we've got July 31st, 2013, they purchased $32,000 worth of inventory on a 1 year, 10% note payable, journalize the company's accrual of interest expense. Okay, so the interest expense is going to be, when they borrow, or the accrual, I guess I should call it. Or sorry, not borrow. That's looking at the wrong section here. A. $32,000 times 10% times July 31st. So August, September, October, November, December. 5 months over 12 is going to be $1,333. Okay, so this would be 31 December 13 debit interest expense 1333 and credit interest payable. Okay, now we have to journalize the payment of the note plus the interest on, oh, that should read July 31st, 2013. So we had 5 months in the old year, 2013. We now have the remaining amount, the 7 months left over. So we're paying the note, which means the note payable has to disappear, and we'll do that by debiting note payable, and it was $32,000. So, and I suppose we should date this, eh? This would be 31 July 14. Okay, debit note payable. And we also have to make the interest payable go away. And that's that guy there. Okay, but we've also had the use of this money for 7 months in 2014, so we have to record a debit to interest expense, and that'll be 32,000 times 10% times 7 divided by 12. So 32,000 times 10 times 7 over 12. $1,867, and then we can credit cash for $35,200. All right. So refer to the data above. Show what Langley Corp reports for the note payable and related interest payable on its balance sheet at December 31st, 2014, and on the income statement for the year ended that date. Okay. So Langley Corporation, balance sheet, and we can call it partial balance sheet, I suppose, as at December 31st, 2014. Current liabilities, and then we have, you know, AP and whatever other stuff, and then all the way down to note payable, right? $32,000 and interest payable, and at that time we had interest payable of $1,333. and 33. And then Langley Corporation has similarly income statement, for the year ended 31 December 2014. And then under the expenses section, have a bunch of stuff, and interest expense $1,333. Okay, now going back to looking at the GST, when we record on the purchase of something now, we record GST recoverable, right? So we buy something, we pay GST, that goes to an account called GST recoverable. But when we sell something, we collect GST, right? And so that becomes, that gets recorded in an account called GST payable. And when we, at the end of the month or a quarter, depending on the size of our business, we have to send a tax return for GST to the government with a check, and we'll show you how we go about figuring all that out in a second. So, let's see, what do we got here? So Brenda records service revenue of $3,000, okay, and collects GST on this amount. So she's done some work, and if you remember earlier, we had some supplies. So Brenda did a bunch of work, but in the course of doing this this job, she also spent some money on supplies. So she's got a GST recoverable of $5. And in this case, she bills for her time. So at the time of the sale, or the service billing the customer, she's going to debit accounts receivable, and she's going to record service revenue, not sales revenue. Service revenue of $3,000, we said. And she's also going to credit GST payable on the amount of GST that she charges the customer for this job, because the GST isn't hers to keep, it is merely what she is holding for the government until such time as she actually goes and pays the government. So the amount that she actually collects is $3,150, assuming she gets paid her AR. Okay, so now she has to make the remittance. And let's say that this is she remits monthly, and this is the only business she did in the month. So what has to happen? Well, first we zero out our GST account. So we zero out GST payable by debiting. So GST payable, debiting for $150. But we also have that GST recoverable account, right, where we paid GST and we recorded the $5 that went in there. And so what happens is we zero out both of these accounts, and the net amount is actually what we pay to the government, which in this case is cash of $145. So the beauty is the profit on the sale is the only thing that we're paying tax on, right? So this is the tax we collect on our revenue, this is the tax we pay on our expenses, and the difference between the revenue and the expense from a tax perspective is what we're actually paying the government. And that concludes part 1 of this lecture.